Are you safe when you diversify? That's the topic of this week's Stockscores Market Minutes for July 23rd, 2012. For more information on our newsletter, you can subscribe for free at stockscores.com/newsletters.asp. Diversification is the traditional way to manage risk. The idea behind diversification is to own assets that are not really correlated to one another. Traditionally, you would maybe have in your portfolio a number of different stocks. One might be an oil and gas stock, one might be a technology stock, maybe a healthcare stock, and perhaps an industrial stock, something like that. If one sector is doing poorly, then it should be overcome by strength in another sector. And that's always been, as I say, the traditional way to manage risk, although it's really not the way that I believe is best to manage risk. Well, what's happened in recent years is because of the rise of exchange-traded funds and the speed at which information moves, we find that the market in general moves together, and diversification is no longer a great way to limit your risk. In my opinion, the best way to limit risk is by managing the size of the losses that you take. When you buy a stock, you should, using basic chart analysis, identify that price point where that stocks or where the market has proven that trade to be wrong. And when you hit that point, you get out. And so you know going in what your downside risk is, and you don't take a position that is so large in that stock that it would overwhelm the performance of your portfolio. At the same time, I don't think it is wrong to own multiple stocks in the same sector, and here's why. As traders, we beat the market by playing alpha. Now, alpha is that part of a stock's risk that is based upon the company itself. And when stocks are trading alpha, what that means is that they are trading on their own story. So for example, you might have a biotech stock that is testing a treatment for a cancer or a serious disease, and that stock is going to move based on whether their treatment is effective or not. They're not going to move a whole lot on what the economy is doing or what's happening in Iran or Iraq, something like that. That stock is going to perform because that company's drug is approved. Now you could have another biotech stock with a totally unrelated drug, which again is pending approval in the next couple of months, and that stock is going to trade again totally on that company's own story. And so you could have two stocks in the same sector, each with a very different situation, each dependent upon what that company is able to do, and whether they succeed or not will determine where that stock goes. Now, by owning two stocks in the same sector, some would say you're not diversified, but if you're trading alpha, if you're trading that component of a stock's performance that is not correlated to the overall market, then it really doesn't matter. And as traders, if we are going to beat the market, you have to focus on alpha. If you want to just do what the market does, go out and buy an index fund. Go out and buy one of these exchange-traded funds, and you will earn what the market earns. I personally think that's boring. I personally think that you're not going to get ahead by doing that, given that the S&P 500 has gone absolutely nowhere in the last 12 years. But along the way, there's good moves that you can take advantage of if you trade the right stocks and if you focus on alpha. So I no longer, well, really I never have, but I don't manage risk using diversification. I manage risk by limiting the size of my losses so that on any single one position, I get out when the market tells me to go out, get out. All right, let's do our analysis on the market itself. The S&P 500 last week rallied up to resistance at the downward trend line and got stuck there. It's not a surprise then that the market would move down as it did today to the upward trend line that has been underway since the start of June. We're getting to the point where the swings up and down between these two lines is getting more and more narrow. And that tells me that we are on the verge of making a directional break one way or the other. Now, the topic that was on everyone's mind today was problems in Europe, particularly whether Spain was going to go into some sort of default, and that is what caused the market to gap down. But notice that it gapped down today, but it didn't break that upward trend line. Through the day, the buyers came back and defended the market because there's also this sense of optimism that perhaps there'll be a change of leadership in the United States, or at least a resolution to the government gridlock that exists in the United States. Perhaps there will be some sort of quantitative easing round 3 out of the United States. So it's really a battle between what's going on in Europe and what might happen with the Fed or what might happen with a new US government. And that is what is going on in the market right now. If one wins over the other, we're going to get a break in one of these lines. If the problems in Europe win, we're going to get a break down through that upward trend line that has been underway since early June. If, on the other hand, we get some quantitative easing, or if there's some signal from the US that the gridlock that exists in US politics is going to be broken, or some other favorable thing, perhaps earnings start to improve, well, that will break that downward trend line and we can start to move higher. What is important, however, is that we approach the market with some caution right now because we are on the verge of a directional break in one way or the other in the very near term. And you should be watching this chart of the S&P 500 very closely to look for the direction of that break. Now the TSX is in a similar situation, although its chart is not as favorable because, of course, the TSX has a heavy weighting on commodities, and with a global slowdown in the economy, commodity prices are not doing so well. But again, we're getting to that tip of the pattern where these two lines are converging toward one another, and you will get a break one way or the other. And again, it will depend a lot on whether the market takes the optimistic path or the pessimistic path in the next few weeks. The VIX had a break from a falling wedge pattern today. That is a bearish sign for stocks, a bullish sign for the VIX, but it failed to hold those gains. It was strong in the morning and then it kind of fell off toward the end of the day. So I wouldn't call it a real strong break in the VIX. Now, of course, for those of you that don't know, the VIX is an ETF. Well, this is a VXX. This is an ETF based on the Chicago Board's Option Exchange Volatility Index. And during times of fear, this thing will rise. So because there was some worry this morning that Spain was going to run into some difficulties, their bond yield are getting very high over in Spain, and that caused the market to gap down, which caused the VIX to gap up. This is a good way to make money from a downward market, assuming that that downward market is motivated by fear, and that may happen in the next few weeks. So you want to keep an eye on this chart because it can be helpful in that regard. 20-year bond, the 20-year treasuries in the US broke to new highs today. Again, that is bearish for stocks. That means people are hiding money in safe assets, namely the treasury bond market in the US. But also notice that while we had strength in the morning, it tailed off toward the end of the day and it couldn't hold those gains. So I don't think we've got a real strong signal that money is looking to be hidden in the safety of treasuries where it really earns almost next to nothing. But this is also another important chart to watch. If this continues higher, that's probably going to lead to a breakdown in the stock market. If this breaks that upward trend line, which has been underway for a number of months, then we're going to see strength in stocks. So keep an eye on this chart as well. US dollar will tend to go up as money comes into US treasuries because, of course, people have to own US dollars to buy the treasuries. And it surged higher again on the open today, but it failed to hold that strength. So the market's really showing a good deal of indecisiveness. Generally speaking, we have optimism in this chart, just as generally speaking, we have optimism in the treasury bond market. Generally speaking, we have some pessimism building in the stock market, but we haven't got that definitive break out of the tip of one of these patterns to tell us which way things are going to go. Now, gold normally is a hedge against the printing of money, and with the rumors surrounding perhaps the US printing more money, you'd expect gold to go higher, but it really hasn't. And that tells me that the market believes that if the US prints more money, it's going to actually help its economy, which is going to make the US dollar stronger, which means gold will go lower. So we've got a reverse relationship with gold and the US dollar over what we had last year at this time. And for that reason, I'm not really too optimistic on gold. It's not reacting in the way that you would expect during times of turmoil. And when I see things that don't make sense, you have to think that there's something else going on there. Oil prices have been rallying over the last few weeks, basically coming back from very oversold conditions. I think that rally can continue up a couple more dollars here on the oil ETF. But I don't expect that downward cycle is going to be broken until the global economy gets better, unless there's some political upheaval somewhere that causes people to have a concern over supply of oil. I believe we'll probably see oil continue up higher in the next little while, but not so much so that I think there's a good trade there. So I am neutral on US stocks, Canadian stocks, and oil, bearish on gold, but I want to say that I'm very cautiously neutral. I'm actually on the negative side of neutral, I would say, with the stock market. As I said, the market is approaching a reckoning point where a directional break will telegraph the next major trend. This break should come within the next month as we are getting to the tip of that pattern, and caution is recommended. If we get a break to the upside, then we can start buying again. But for now, I want everyone to be pretty cautious with stocks going forward. We'll have a great week in the market and trade well.